So most of my students know what I'm actually going to be teaching, and some don't know, some know. So when you come to the chart, this chart, for those that don't know, I trade Euro USD only. Not that I don't look at other pairs. I look at other pairs, but I major on Euro USD. I can see a pair, I can see a setup on USD card. Like I saw on Friday. I wanted to post it on my group, but I just kept it to myself. I can see a setup and I'll just quickly take it and stuff like that, depending on the mood and psychology that is encompassing that trade at that moment. But I major on Euro USD. Why? Because Euro USD is not volatile like every other pair. I like it nice and slow. Don't give me the volatile vibe, just nice and slow. Give me my money quietly. I'll take it easy peasy. All right. So, like Euro USD, I've monitored the trade, the pair, I've learned it, and I know what it can do and what it cannot do. So, when you come to the chart, I believe each and every one of us here are day traders. Nobody here is a swing trader. All right. Nobody here is a swing trader. So, at the end of the day, what is your focus? That's what you should ask yourself. What is your focus? What are you looking at? Now, as a day trader, why is this in the lens? Okay, excuse me. As a day trader, I will always advise that at the end of every month, try as much as possible to do a top-down analysis that will cover the monthly, the weekly, the daily time frames. All right? The monthly, the weekly, the daily time frames. Now, I'll be teaching us just two concepts. I'll be talking on liquidity, and I'll be talking on the breaker block. And I'll be I think these two is what I'll be talking on, right? Now, liquidity and the breaker block. Now, breaker block, I'll be talking about two forms. Liquidity, I'll be talking about two forms. Now, we all know that in every chart, we have, let me use our normal retail terminologies. We have the supports and we have the resistance. So in every, as far as ICT concepts is concerned, every support and resistance on any time frame is actually every resistance and every support on any time frame you are on, be it 1 minute, be it 1 minute, be it 15 seconds, be it 1 month. As far as you have the resistance and you have the support, that is your external liquidity. We have the liquidity up and down, that is the high and the low. We have it to be the external liquidity. Now, this now gives you a range. Forget about this one. Don't look at this one. Look at from here, from this high to this low. What do you have? Now, looking at this high to this low, you have different bearish candles. The bearish candles are in black. The bearish candles are in black, and the bullish candles are in black, and the bullish candles are in green. All right. So you have the bearish candle, we have the green candle, the bullish candle, which is the green candle. So from this place now to this place, you would see that there are just a few bearish candles, and here there are many bearish candles. Now, why? Price will always seek liquidity from internal to external, and from external to internal. Let me say it again. Price will seek liquidity. I will not need to start typing this in because it will take time. You just have to jot it down. Price delivery will happen from internal to external, and from external to internal, no matter the time frame. Now you should understand that all these time frames is fractal. Forex is fractal. Whatever it is that is happening on the 1 month time frame is still the same thing, the same pattern, the same system, the same method that you will see on the 1 minute, on the 15 minutes, on the 5 minutes, on the 1 hour. Is all the same thing. All right. So now we have different PDRAs that you are going to look for inside here. Back to what I said, your resistance and your support are external liquidity. These are external liquidity, that is any liquidity above here and any liquidity below here is external. It's outside this range. That's what makes it external. Now, let's look at the PDRAs that you will look out for once. So inside this range now, from this high to this low, this is what you are going to look out for. So let's use a fib. Let's use a Fibonacci and measure from the high to the low. So you would see that on this price now, you see that this range has been divided into two automatically. It has been divided into two. So now what is the name? What is this being called? What is this being called? I think, let me, how do I do this so that people will stop? Just go straight in. What is this? Allow. Never waiting. Okay. Yeah, so I've done that. So now, if you are to watch on this price, you see that from this low to this high, it has been divided into two. All right. So let's give it a name. Let's give it a name. Now you see that in this box now, remember we had price here. We marked the low and we marked the high, all right? We marked the low and we marked the high. Now, this downward part, this downward part, it is called discount point of interest, discount zone, discount liquidity, discount whatever you want to add to the back, but it is discount. So let's just imagine that you are buying, you want to buy a pair, right? You want to buy a particular pair. You are not going to buy it when it's very high, because buying it at that price will be very costly for you. You want the price to come a little bit down, you know, just like when you want to, if you want to buy a particular goods and you go to the market and it's 2 times what it was before, you'll be like, oh, okay, oh, let me wait for this, let me wait for the price to come down, so that maybe if there's any changes or anything that happened in the economy that made the price to come down, then you now go and buy. So you are actually waiting for discount, all right? You are waiting for a discount to actually buy that thing. So in that discount zone, I call my own discount zone. I call it discount zone. Okay. Sorry. I call my own discount zone, DZ. So if you see me, if you see any of my charts and you see this DZ there, know that that is actually a discount zone. All right, that's its discount zone. So now in this discount zone, what are you looking for? You are looking at old low, rejection block, bullish order block, fair value gap, liquidity void, bullish breaker, and mitigation block. That is the things that you are actually looking at on this discount zone. I am not going to be talking about this in details. Then likewise, the premium is you have gotten a goods and you want to sell, but the price in the market is not favorable for you. You want to hold that goods more, and then at the end of the day, you actually sell it off when the price has gone higher. That is premium zone. So in this premium zone, you are looking at old high, rejection block, bearish order block, fair value gap, liquidity void, all the way down to bearish mitigation block. All right? These are the first thing that you are looking for. So if you don't see a rejection block, remember your old high and your old low are your external liquidity. External liquidity. Your old low and your old high are external liquidity. So inside that old low and old high, what are you looking for? You are looking for a rejection block, bearish order block, fair value gap, all the way down to mitigation block. So if you don't see, there is no way inside a premium zone that you will not see one of these liquidity, internal liquidities. So you should know that old high, old low is your external liquidity, while your rejection block, bearish order block, fair value gap, liquidity void, bearish breaker, mitigation block, blah, blah, blah. All this is internal liquidity. Internal liquidity. All right? I'm still going to show you, like I said, we are going to talk about the bearish breaker block. This is one of the best entry strategies out there. Best. Like it is one of the best. So I'm going to talk about it. We are going to talk about continuation and we are going to talk about reversal. So once you have determined your premium and your discount, you now determine your external liquidity and your external liquidities, which is your old high and old low. Now, the next thing you are looking out for is your rejection block, bullish order block, fair value gap, all the way down to mitigation block. So now this is what you do. So inside this, every down candle, inside this range, every down candle is a bullish order block. Every down candle is a bullish order block. Every down candle is a bullish order block. I hope you are following. Type on the chat box if you are following. Type a 1. Type a 1 on the chat box if you are following. So from this range to this range here, from this range to this range here, every down candle is a bearish order block. Or sorry, a bullish order block, because we are actually going higher on this range. That is from this high to this high. I'm not talking about this one. I'm not talking about this one. So from this high now to this high, every down candle is a bullish order block. So now, when we have established this range, you see that price started falling. And where did price get to? For us to actually buy, for us to buy this market, where did price get to? Price got to this bullish order block here. It came and mitigated this bullish order block. Now, you should also note that in this zone, we have a fair value gap. We have this fair value gap here. We have this fair value gap here. We have this fair value gap. So all of them can be regarded as liquidity void, because if you go higher, let's see on 3 months. Good. So you see, if you go higher, you see that this is just one candle. From here to here is one candle. All right. So it was only one person that indicated that he's following. The rest, are you lost? Please let me know and where you are lost to. So if you check here, you will now see that this is a liquidity void. Remember, in our discount zone, inside this zone, where did we see the liquidity, or this liquidity void and fair value gap? It is below the equilibrium. That is 50% of this range. It is below here. So when price started getting to this point, you should be looking at, okay, it has come to the zone where I would want to buy. Now, just having that narrative of I want to buy is not enough for you to enter a trade. It is not enough. You need to know, you need to have a reason why this market will actually support your analysis and buy. Like I said, we're on the monthly time frame, all right? So we have the liquidity void, we have the bullish order block here. So now, what is the one thing that will give you that confirmation that, okay, they are about to move this trade? That takes us to the breaker block. Now, you can let me use this illustration. Let me use a diagram. Now, market structure of a bearish movement, it gives you a higher high, a higher low, a lower high, a lower 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 low. So you can agree with me that this is a downtrend. This right here is a downtrend because we have a higher high here. We have a higher high here. And now instead of having a higher high, instead of having another high that will take out this one, it now gave us a lower high here. So we have a higher high and a lower high, and we have a lower low, and so on. So the one particular thing that is going to give you that confirmation that you see this market now here, that they are about to buy this market, is when you have a change in market structure or a shift in market structure or market structure shift or break in market structure or break of market structure. All of them is the same thing. Anyhow you want to call it, all of them is the same thing. Now, what do I mean? Instead of markets giving you this lower highs and lower lows vibes, instead of giving you that, it now took out a lower low. It took out this lower low first, giving you a lower low. Now, instead of giving you a lower high, it now gave you a higher high and a higher low and another higher high. So this right here is a clear confirmation that they have shifted the market from a bearish sentiment to a bullish sentiment. It is as simple as that. Now, this right here now, this pattern here is what we call the breaker reversal pattern. The breaker reversal pattern, because if you watch in a market, is either you are reversing or you are riding the trend. Is either you are reversing the trend or you are riding the trend. You should remember that the trend is always your friend. This one no be advice. This one no be advice. If you want to trade against the trend, go till low, you don't go. So you should always trade with the trend until you get a confirmation that, see, they are about to move this market and change. Now, you should also notice something. We have this place as the origin of this downtrend. Remember your external liquidity and your internal liquidity. So we have these ranges here now to be the external liquidity and the internal liquidity. So you are working with this range from here to here. Old highs, old lows. Now, this is your reversal. Now let's work on continuation. The continuation setup, we are in a downtrend. The market is obviously in a downtrend, and you are having your lower highs and lower lows, lower highs and lower lows. Now, because the trend is your friend, how do you enter into such trend without looking for reversal, without missing out? Now, this is how you do it. Now you see that the market is giving us, guys, we have 9 minutes, less than 9 minutes or less than 10 minutes to this meeting to end. Once it ends, you jump back in. I'll drop another link. I'll drop another link for you to jump in. So we have this lower low, lower high, lower low, lower high, lower low, and you are obviously in a downtrend. All right. Now, this is how you are going to enter this market without missing out on all of this. Number one, you need patience. Number two, you need to identify your range. You need to identify your range, and you need to identify that this is an actual trend for you to join the trade. Now, once you see that price have taken out this low with this, because it was this low that took out this one, what are you waiting for? You are waiting for a reversal. You are waiting for a retracement, not a reversal. Sorry, you are waiting for a retracement back to this low. A retracement back to this low. Now, from this high to this high, from this high here to this high here, you will have series of other blocks here, and you have series of fair value gaps here. You have series of other blocks here. You have series of fair value gaps here. I don't want you to complicate things, but just see it in that light. You have this as a fair value gap, and you also have series of what other blocks here. Now, how do you trade this? You wait for the retracement, and then you enter at this. So you enter on the retracement of this particular candle. So this candle right here is your breaker. This candle right here, this candle, let me even bring it down. So whatever candle that you have here, from the open to the close of that candle, or from the open to the close of that candle, is your breaker. Now you trade that, and you just put in your risk reward, your risk to reward above the high of this candle, and then you now target to wherever your take profit is. You target external liquidity. Now remember what I told you initially. Price moves from external to internal and internal to external. All right. So we'll head over to the chart so that I will show you the examples before you now ask questions. So after doing all this, remember, you are doing your analysis. You are trying to know where your external liquidity is on the monthly time frame and other time frames, from the weekly to the daily and stuff like that. So we have this as the fair value gap. We have this as the other block. We have this as other block. So how do we use this context? How do we use this context? On the weekly time frame, your duty is to anticipate, okay, we have taken out this liquidity here. So after taking out this liquidity here, where is the next place price will likely go into? Now, you remember when I told you they are going to give you high, lower high, lower low, lower high, lower low, lower high, and lower low. Now, inside this range, you will see that there is another high here, but this is actually the break of structure. All right, this is actually the break of structure. You see a low here, you see another low here. Okay, this low is lower than this low, so it makes this high valid. This low here is lower than this low, so it makes this high valid. So this right here is your market structure shift, break a market structure. And then another characteristics on how to identify that we will have a market structure shift is when you have a displacement candle. What do I mean by displacement candle? One monster candle. One monster candle. Be it bearish, be it bullish. One monster candle. When you have that one monster candle, like here now, you see, we had this monster candle taking out this. You see this monster candle taking out this low here. This one taking out this low here. This one taking out this low here. This one taking out this low. So they are actually breaking, like they use a force to break that structure. All right. So when you see that, that is an indication that they have switched from the low to the high. Am I making sense? Please type a 1 if I'm making sense. Just put a 1 on the chat box if I'm making sense. Okay, nice. So once you have this now, remember we have this is on the weekly time frame. As a day trader, the time frame that you are to focus on is the daily time frame. What is the daily time frame telling you? What is the liquidity points on the daily time frame? What range am I working with on the daily time frame? All right? What range am I working with on the daily time frame? So permit me to say that we are working with this range here, this high here, and this low here. Now, why are we working with this? Why are we working with this? Remember, on the weekly time frame, there was this. So it have taken out this external liquidity on the weekly time frame and also on the daily time frame. So it does mean that once we have this right here and we have this right here, what are we looking for? We are looking for reversal. This is what we now indicate to us that, okay, our bias has now changed from sell to buy. Our bias have changed from sell to buy on the daily time frame. Now, this can play out in months. It can play out in, it can even take a year to play out. Like you can see from, you can see on this time frame, we have the whole of 2022. The whole of 2022 down to 2023 was a bearish what? A bearish market. It was late 2023 from November till December that we had a break in market structure. So you would have been a buyer. You would have been looking for buy opportunity, buy opportunity, buy opportunity. This time frame now, if you are looking to take any trade from this time frame, you are a swinger. You are a swing trader. So when I said as a day trader, focus on the daily time frame, is number one, you are marking your external liquidities. Now, inside those external liquidities, what is the liquidity that is inside the internal liquidity? We have this here, we have this here, we have this here, we have this here, we have this, and we have this. Now, inside all of these highs, we also have fair value gaps, and we also have. So what I was saying, yeah, that when I said focus on the daily time frame, I don't mean take your entry from the daily time frame. No. When I say focus on the daily time frame, I don't mean take your trade from the daily time frame. I expect everybody to be muted, please. So when I said focus on the daily time frame, I don't mean you should take your entry from the daily time frame. You get? So now, this is it. As a day trader, your focus is on the opening and closing of one candle. Now, another thing I'm going to actually teach, this one will be specifically for my community, Sha. It's not going to be a general thing. When to expect this type of move. See, this is a lot of pips. When to expect this type of moves. How do you expect and you know this type of moves? I'm going to teach it to my community. Maybe one of the days I'll just put out that training. So now, as a day trader, your interest, your focus is, where is the opening of this particular candle going to be? Where is the closing going to be? Is this candle going to expand lower or is it going to expand higher towards a predetermined liquidity point? Now, remember I told you that we have the breaker for continuation and we have the breaker for reversal. We have external liquidity and we have internal liquidity. Now, external liquidities are your highs and your lows. The fair value gap, rejection block, fair value, order block, mitigation block, and others are your internal liquidity because they are inside the highs and the lows. That's what makes it an internal liquidity. Now, even inside that internal liquidity, you still have highs and lows. So there are major external liquidity and there are minor internal liquidities. But then the major internal liquidity, your fair value gap, other blocks, blah, 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 and stuff like that. Now, you should understand something. Before any market will move, it must take liquidity. It must grab liquidity before any market will move. Now, you should understand that this market is being manipulated. It is manipulated, but it is not manipulated randomly. The market doesn't move in a random whatever. It does not move that way. It does not move in an unrandom manner. It moves in a programmed manner. So there is a set of rules that this market applies on. And the foundation is based on liquidity. That is A to Z. Every other thing is built upon liquidity. I don't know if I'm making sense. Every other thing is built upon liquidity. Type a 1 if I'm making sense. Type a 1 in the chat box if I'm making sense. So, once you have understood the premises or the narrative behind this your, okay, oh, where is my external liquidity? Where is my internal liquidity? Where is it? Once you have marked it out, the next thing you are looking out for is, where is the daily candle moving to? Where is it expanding to? Because we have 4 methods of price delivery. We have 4 methods of price delivery. We have consolidation. We have expansion. We have reversal. And we have retracement. Let me say it again. We have consolidation. We have consolidation. We have reversal. Why is it doing like this now? We have expansion. And then we have retracement. This is what price does. If price consolidates, it either expands or it retraces. If there is reversal, it either expands or it retraces. If price consolidates also, it either reverse or it retraces. So all of these are interrelated. And this is just exactly what the market does. We see consolidation, we see expansion, we see consolidation, we see reversal. And inside this is a retracement. Consolidation, reversal, consolidation, retracement, and expansion. So after consolidation, we have expansion. After consolidation, we have reversal. You understand? So we have these four methods of price delivery. So back to what I was saying. So on the daily time frame, your business is to what? Know where is this market going to expand to? Expansion. Where is the market that particular day? Be it Monday, be it Tuesday, be it Wednesday. Where is it going to expand to? By the time you now know, okay, where this market is likely going to expand to this point, either buy or sell, either higher or lower, then you now go to your smaller time frame. So let's say on the daily time frame, yeah, you have inside this range, you have your internal liquidities. So permit me, let's mark the internal liquidities together. Let's use recent price action. So inside this recent price action, we have this high here, which is very obvious. We have that liquidity there. So what's the next thing? Inside this liquidity, what's the next thing that is above it? We have this other block. From this high to this other block, what's the next thing? Can anyone tell me? Type it on the chat box ASAP. On the chat box ASAP. From this high to this other block here. From this high to this other block here. What other liquidity points is in between this here and here? Good, fair value gap. So we have this fair value gap. So what you do is extend all of them. Look at, are you seeing how price has respected that fair value gap to the people. So this now is on the daily time frame. Now you move to the 4 hours. If you move to the 4 hours, you do not see anything, you move to the 1 hour. Now, when you move to the 1 hour, remember, we have the breaker set up for entry. So how do I enter? How do I participate in this market? What will I see? What will I just see in this market now that will make me know that, okay, oh, these people are about to do what? They are about to retrace, because number one, they have traded into this internal liquidity on the daily time frame. But on this H1, it is an external liquidity. Let me say it again. Price is fractal. What you see on the daily time frame is the same thing you see on the 1 minute time frame, is the same thing you see on the 5 minutes time frame. Now, every internal liquidity on the daily time frame can be an external liquidity on the 1 hour time frame. Why? Because the daily time frame is actually a higher time frame. I hope I'm making sense. The daily time frame is a higher time frame, and you want your analysis to be in line, to be in alignment with the higher time frame. So when you are having a premises with the higher time frame, it is going to help you to now know, okay, this is what they are likely to do. Number one, you need to understand that this game is a game of probability. Nothing is absolute. Nothing is absolute. That is where we are, our teaching tomorrow, the teaching I'm going to have tomorrow for my community. That is what I'm going to teach them. There is just a whole lot. I told them the other day, there were some people that told me, when I told them that they should pray for me, like my head was blowing when I noticed and I understood this concept. Very simple. You don't need to communicate, you don't need to add any other thing. It's just very simple. When you have your daily time frame, you have your POIs. That is your zone. Remember, we have the discount and the premium. We have the premium and the discount. So when your smaller time frame is in alignment with the higher time frame, that is when you now say, okay, I can be able to take this trade based on what it is showing me. Now, we have gotten to this fair value gap on the daily time frame, which is an internal liquidity on the daily time frame. But on this H1, it is what? External. Why? Because we already have this high that was taken out. This high here that was taken out. Remember, your old highs and your old lows are your external liquidity. I'll still give us another trick based on entry. Now, once you have this and you see that price have tapped into this daily fair value gap, what are you going to do? The number one thing you are going to do is stop trading. Stop trading. Don't be inquisitive to enter the market again. Don't be inquisitive to make another dollar. Just stop trading. Once you see that an external liquidity on the higher, on that particular time frame, which is an internal liquidity on a higher time frame, has been reached, stop trading. So when you stop trading, what are the things that you actually see? Now, I'm not just going to show you only this on this recent price action. It is on other price action even before now. but I bet you have not been seeing it and you have just been overlooking it. We have consolidation. So after consolidation, what is the next thing you have? You have reversal or expansion. Now, that brings me to another concept, which I'll just talk about briefly. Power of three. Now, in every candle, there is an open, there is a high, there is a low, and there is a close. So in this candle now, let's say this is a bullish candle. So permit me to say that, let's say this is a daily candle now, a daily candle. So let's use here as an instance. This was between 12th to 13th. Good. Very perfect. Perfect. Now on 12th, which is on Wednesday, between 12th to 13th, you see how this candle did. Now, this is exactly this candle on the daily time frame. Let's look at it. Let's look at it. Let's look at it. Good. So do you see this illustration that I made? You see this particular candle? So you see this particular candle, you see the wick here. Let me remove that. You see the wick here. You see the wick here. So this is the low of this candle, and this is the high of this candle. Remember, as a day trader, your interest in a bullish trend, you are looking for buys. In a bearish trend, you are looking for sells. You have no business catching a sell in a buy market. You don't have any business catching a sell in a buy market. So now the power of three. You see how they opened here? Now look at this number, value, the number value that you have here. On this particular candle, you see that the opening of this candle is 187. The low of this candle is 134. Now see the low here, 134. See where they opened, 187. And what did they do? They expanded higher. Now let's go to the smaller time frame. Smaller time frame. Now you see the beginning of this candle, the opening of this candle. What did they do? They moved from here, opened here, went lower, accumulated here, manipulated here, and distributed here. So power of three, you have accumulation, manipulation, and distribution. So before price moves in an anticipated move, it must first of all take liquidity. It must first of all grab liquidity. Whether the liquidity is internal, whether the liquidity is external, there must be a liquidity. There must be a fulfilling of order. There must be a grab of order before the market will actually move in the right direction that it's supposed to move. When you are able to understand this and apply it across board, at least you will be 50% profitable in this market. So you see how they did this on this candle. So now we have traded, we have bought into this fair value gap. Remember this fair value gap from the daily time frame. This fair value gap from the daily time frame. Now what did they do? they wicked. First one came back again. Second one. Now put this down. Weeks does the damage. The bodies tells the story. Weeks does the damage. The bodies tells the story. Weeks does the damage while the body tells the story. Now, understand, this is a higher high, this is a higher low, this is a higher high, this is a lower low, this is a higher low, this is a higher high, this is a higher low, this is a higher high, this is a higher low. Now, in this market, let's use this as a tool. Higher high, higher low, higher high, because this one is higher than this. Higher low, higher high, because this one is higher than this. Higher low, higher high, higher low, and a higher high. So now in this scenario, you can see that we have a bullish move on this. You can see we have a bullish move on this. Now, instead of price taking out this high to give us this, because if you watch, this low was respected. This one was not respected. This low, they took out this low. They took out this low here. This low was respected. This low was respected. This low was respected. What they did was they came, grabbed liquidity, and went off. They came here, took out this one, went off again, and gave us a higher high. So let's use this. This is the true low, and this is the true low. This is just a fake out. All right. So this low was respected. This low was respected, and this low was violated. So instead of them either coming to grab liquidity and move on, or do not come to it at all, what did they do? They ended their journey here. After ending their journey here, what did they now do? They now came down and broke it here. Even broke it down to this place and gave us another high here. And this, then this. So you can see that we have a breaker here. You see that the market has broken, and the market has given you what? A shift in market structure. Now, this pattern becomes valued. Why? Because it has traded into a higher time frame, premium zone, internal liquidity and external liquidity on the H1, and it is an internal liquidity. Why? Because it's a fair value gap on the daily time frame. External liquidity, because if you check on that zone, you will see that if you check on that zone, you see that there is a high. You see this high here. There is a high between here and here, or between here and here, that gives you that gave you that fair value gap. So that was traded into. So at the end of the day, what is it giving you? It has given you a change of structure. Now, once it gives you that change of structure, what is it telling you? What is it implying? Who can tell me what is implying? ASAP on the chat box. What is it implying? We have this breaker here because it closed with a full body candle close. Now, I don't like my breaker to give me I don't like my breakers to give me weak. No, I determine my breakers with a body candle close. Now, if you watch closely, you would see that with this move here on the same day, it gave you that breaker. So that is confirmation number 2. Confirmation number 1 is that it traded into the higher time frame PDRA. Higher time frame PDRA, internal liquidity on the daily time frame. So the next confirmation you have is what? A breaker, because it gave you market structure shift here. This is a valid low because we have this as a valid high. So it gave you that body candle close. So the next thing that you are now looking out for is which candle broke the market? Which candle did it use and break the market? Now you should understand, in every valid breaker, there must be a high or a low that is violated. I call that fuck you. That is why on my chart, most times, you would see this. You would see this. There are many traders that will want to sell from this market. They will want to sell here. They will tell you, buy high, sell low, or sell low, buy high, whichever one it is. There are many traders that want to sell here, forgetting that there is what? An internal liquidity on the daily time frame, which is in turn an external liquidity on the H1. So what did they do? They used this week to damage their account. Now, after damaging the account, I was right though. I was right in this analysis, but they took my stop loss. This is it. So after taking them out here, it's not enough. They took them out here again. They took them out here again. And what did they now do? They now retraced it. This market is manipulated. The market makers have taken my money. It's a lie. You are the one that is, you are not seeing, you are not doing proper analysis. You are not preparing well. So, confirmation number 2. Now, after this, you also have this BOS here. That small tiny BOS thing, which is break of structure. It broke here and broke here. Now, you should understand, they are no longer coming back to this high. They are no longer coming back to this high. Even this one now that broke here, they did not come back to this high. It means that this high now is now protected. This high, this particular high, is now protected. I'll have to rush this thing so that they will not give us another 9 minutes again. So it means that this high is protected. So after you get this break again, what did it give you? It now gives you, number 1, it gave you the breaker. It gave you the breaker. So you have this as the breaker. The next thing it gave you, order block. Order block. So now it is now left for you to now say, okay, I've gotten break of market structure on H1. Now let me dial to M15. That is where you now start seeing the so many noise from M15 down time frame downwards. That is where you have the intraday time frame. M15 is the intraday time frame, is the day trader's time frame. That is where the day trader is actually looking at entering the market. All right. So you have your order block on the H1, you have your breaker on the H1. Now you should understand, once market trades back here and takes out this high, your sell narrative is violated, is invalidated. As far as price stays below your order block, your breaker, and this high, price is valid. Price is valid. So in these time frames now, you are now looking out for sell market. You are now looking out for sell market. So this is how you would have captured more than 150 pips last week. This is how to run your top-down analysis. Now, remember, I went from the monthly time frame down to M15. From the monthly time frame, I went down to M15. All right? So, inside this intraday, there is an analysis on its own, but this one now is for the higher time frame, knowing your narrative, knowing where the market is actually going to go to, knowing where the market is expanding, and you taking position in line to where the market is likely to trade to. You don't have any business buying in this market. You don't have any business buying. You don't have any business buying. Your only business is to sell. Even if you sell and it take you out, sell again. In as much as this setup is intact, in as much as this setup is intact, in as much as this setup is intact. Now, look at this place again. What do we have here? We have consolidation, manipulation, and what? Expansion. On this 1 hour time frame, you see, we have this as liquidity. And this liquidity here on this 1 hour time frame is an internal liquidity on a higher time frame. Now, let me use H4 in this instance because I love the H4 well. I love the H4 so much. Permit me, if you can believe with me, you can see that this block here, this bearish candle is responsible for this bullish movement. Yes or yes? Yes. You mark it and it becomes your what? Your order block. So did you see how price respected this order block? That is an internal liquidity range on H4 time frame, but came back to it again and bought. Now you should understand what is your overall bias. Buy, bullish. So whatever they are doing here, you should know that it is a short sell for a long buy. Short sell for a long buy. I hope I'm making sense. So on your H1, that becomes an external liquidity because why? You are working with this range, this high, and this low. So in order to refine this well, you see that low, you see that high. Okay, this low was taken out by this. So you see this one and this one. What did they do? They came back to it. Now, when they came back to it, what did they do? They quickly, remember, displacement candle took out this high. They took out this high, gave you this fair value gap, gave you this other block, and off it went, taking out all of this. Taking out all of this. I made this analysis with my community I don't know how many people that took it and stuff like that. This particular trade pained me because I was looking at the H4 and then I have not fully grasped the concept of this internal liquidity and external liquidity, but I have grasped it, and there is nothing where you fit tell me, nothing. There is no other strategy like this now I'm going to trade if not this, because it plays out every day. It happens every day. Liquidity and breaker, liquidity and breaker, liquidity and breaker. That is all. Liquidity and breaker. Fair value gap mitigation block, fair value gap mitigation block, liquidity void, order block. All of them are an example of internal liquidity, and that's all. And that's all. So far, so good. Any question? Please, if I made sense to you, type a 111 on the chat box. If this class actually made sense to you, a 111 in the chat box. All right. Thank you very much. Thank you very much. So